What is liquidity and how does it impact the trades? For that, first let us try to understand what are the different types of orders and how do they get executed. When we place an order to buy or sell, we see mainly two types. It's limit order or market order. Limit order is to buy or sell at a particular price. That means, the order gets executed at the price or better price that we mention. Market order on the other hand gets executed at the best available price at that time in the market. If you have a look at the market depth, the price points in buy side, bid, and offer side, sell, are the ones which are limit orders waiting in queue at specific prices. That means when a matching limit order from the counterparty, buy for sell, sell for buy, comes, the trade gets executed. Or, when there is a market order from counterparty, it gets executed. In this example, if there are market sell orders for 100 quantity comes, the buy orders waiting at 207.1 gets executed for 100 quantity. With this understanding, we can see that there is a gap for orders waiting in queue between highest bid price and lowest offer price. This gap is called spread. This is significant point because when the gap is very small, the market order we execute, likely to be fulfilled at a price which is very close to last traded price. If the gap is more, likely that we will get a price which is not close to LTP. Remember, the queue is dynamic during market hours and it is dependent on the stock. We see that, depending on the number of participants, buyers and sellers, and the volume of trades in a stock, the market depth and spread would differ. How thick or thin the market depth is, dependent on these factors defines the liquidity of the stock. Liquidity here means the ability of a stock to be transacted without affecting the price much. How does it affect our trade? Well, two factors to consider here. First, if a stock is liquid, we will be able to get entry or exit at the price what we see, be it market order or limit. Second, if the liquidity is very less in a stock, the price behavior could be intermittent and erratic. This can be seen in the example here. This scenario makes the stock price highly vulnerable for manipulation. When it comes to options trading, liquidity plays a significant role in trade execution, because very often the options are traded in market price. When option strategies are deployed, the relative price of different legs is what is considered and not the individual strike premium. Since liquidity depends on volume of trades in an instrument, it is evident that the strikes with higher trade volume are the ones liquid as well. It's good to trade the strikes, which is more liquid to avoid big slippage in price. This picture gives a synthesis of average traded volume of a 5-minute time frame for various strikes of Bank Nifty. Note that at different time frame of trading hours, the 5-minute average volume varies hugely on strike position relative to the ATM strike. C0 and P0 are the ATM call and put strikes. 1, 2 are the strikes, those many strikes into the money as the number indicates. The volumes of different strikes are shown as average value of 5 minutes. This is a data computed based on multiple years of Bank Nifty weekly options. From this it's evident that more into the money, there will be less volume and hence less liquidity. This is one of the factors to consider while selecting the strike for your trade.